In this video, we're going to discuss the lower of cost or net realizable value rule. So this has to do with inventory, and generally we put inventory on the balance sheet at cost. So if you pay $80 for some inventory, let's say you're a retailer, it's going to go on your balance sheet at $80. Unless at some point in the future we see that, oh, the net realizable value of that inventory is lower than the cost. It's lower than $80. Let's say the net realizable value is $65. Then we say, okay, now the net realizable value is lower than the cost of the inventory. We need to decrease the inventory value on the balance sheet by taking a write-down of $15 so that the inventory now appears on the balance sheet at $65. So that is the lower cost or net realizable value rule. The inventory will appear on the balance sheet at the lower of the cost or its net realizable value. Now, you might be wondering, what is net realizable value? That's just the expected selling price of the inventories. That's how much money you think that you're going to get for it, minus any cost to complete the sale. Cost to complete the sale could be distribution costs you expect to incur, packaging costs. So let's say you say, you know what, I think I could sell a piece of inventory for $170, but I'm going to have to pay $20 for shipping to get it to the customer. Then we say, okay, well, in that case, the net realizable value would be $150. Okay. Now, a lower cost or net realizable value rule, which is sometimes abbreviated LCNRV, this is according to International Financial Reporting Standards and also US GAAP. However, with US GAAP, companies that use LIFO or the retail inventory method, they're not going to use lower cost or net realizable value rule. They're going to use lower of cost or market, the old rule. Okay, so that's just a little distinction between IFRS and US GAAP. So, but if it's US GAAP and you use FIFO or average cost or something like that, then you're going to use lower cost or net realizable value rule, just like International Financial Reporting Standards. Now, let's do an example. So Amazon came out with a new product in 2014. They came out with a phone called the Fire Phone. And let's say that the cost to produce each Fire Phone was $150. So let's just focus on one phone. We say it costs $150 to make that phone. So then that would be on what would appear on Amazon's balance sheet, right? Obviously, they made many more than one phone, but let's just say that they just had one phone for $150, and the phone didn't sell well. Amazon Fire Phone was not a big success, and within a couple of years, it was pretty much done. They pulled it. They were no longer selling it. But let's say after 6 months, they realized, whoa, we got a problem on our hands. Customers don't really like this Fire Phone. Basically, now we think that the expected selling price is just $100, and we're going to have to, incur some packaging costs or something to complete the sale. So really the net realizable value of the phone would be $90. Okay, so that would be our net realizable value. And I'm just making these numbers up. I don't know what the facts were for Amazon. I just know Fire Phone was not a success. So the cost was $150. The net realizable value is $90. And if we say lower of cost or net realizable value, okay, so then we'd say, okay, we'll compare 150 to 90. Then we say, okay, well, the net realizable value is lower, and it's lower by $60. So then Amazon would have taken a $60 write-down. And again, now Amazon uses US GAAP, so I'm assuming that they use something like FIFO or something. Again, if they use LIFO, then they'd be using the lower of cost or market rule, okay? So now you say, well, what do we do here? We've got this write-down, and in reality, the total write-down, so just in this example, the write-down was $60. But the actual amount, the total write-down that Amazon took for this Fire Phone was $170 million write-down that they took related to their inventory. Now, what do we do with that $170 million? Okay, so this $170 million write-down, how do they account for that? Well, there's a couple of ways of doing it. One is they could basically bury it in cost of goods sold. Investors don't really like this method because then it's like you don't really see, oh, wait, hey, there was this specific write-down that happened, unless the company comes out and discloses it like Amazon did. Another way is a loss method. We actually have a specific line item that says like loss on decline and value of inventory. And I'm going to make another video where I show you the journal entries for both of these methods. So hang in there and stay tuned.